As governments and advisory bodies around the world crank up their regulatory efforts, multinational corporations are increasingly facing major fines, some even in the millions. But is increased enforcement doing more harm than good? Matt Moscardi of Morgan Stanley Capital International shares his thoughts. Now, you have the advantage of having a global perspective on some of these financial trends. Do you think Europe versus the U.S. is one perhaps doing a more effective job at regulating financial institutions?
I think that they're going about it in two different ways, and they're having probably the same level of effectiveness, which is maybe little effectiveness. I think in the U.S., they're trying to just extract as much money as possible from every bank that they're regulating for egregious behavior. And I think in the EU, in the UK, they're trying a very similar to the US approach, but in the EU, they just don't do that at all, and they try a very policy and kind of best intentions approach. Even with the bonus caps, it's more about best intentions. I think the banks themselves know they've been labeled by the Financial Stability Board as too big to fail. They know they have government backing essentially because of that. They're being held to higher capital thresholds, sure, but from a regulatory and policing standpoint, the US and the EU have basically said, we cannot necessarily police you in the interests of market stability. We can't put you at real risk in the interests of market stability. And that means that it doesn't matter necessarily the approach that the regulators take to handing out some sort of enforcement. They are in a bind. As long as the banks are as large and important in these economies as they are, they're in a little bit of a bind of what they can do to begin with.
Okay, very interesting. Now, can you give me some examples of some of those outliers?
We're already seeing the effects of this for Credit Suisse, who pleads criminally guilty or criminal negligence, or they basically copped criminally as part of their settlement agreement with the U.S. for tax evasion, abetting tax evasion. And the effect has been roughly zero on the company, and the CEO has said as much.
Now, Matt, at what point do governments play a role in policing some of those big banks?
That's a good question. I mean, I'm not sure that there is a point until they're willing to disallowing market access rather than meting out fines which are increasingly substantial, but still not deterring behavior necessarily.
Okay. Now, Matt, if LIBOR was calculated by a government agency, do you think we could have avoided the scandal that hit the U.S. as well as the UK a few years ago?
Partially, yes. I think that the addition of a government agency and oversight would at least minimize probably the impacts or the ability of the banks to collude and change the rates. But I also think that the banks themselves have proven they can find loopholes even when there's government oversight. The thing that comes to mind is the municipal market in the US, where there are a number of banks who are actually manipulating the bids and have paid fines for it. So I'm not necessarily sure that it's a foolproof way to oversee LIBOR or SIBOR or Yen LIBOR or any of the other global intrabank rates. But I do think the oversight of a government agency or the direct control of a government agency would most likely limit the impact, particularly in non-large bank jurisdictions where it's smaller banks that are participating.
But still, do you ever worry that, as you said, they might be able to reduce the possibility that collusion is taking place, but at the same time, an overzealous regulatory body would just add costs to investors by delaying the process if they are indeed the ones who are producing these indices?
There's many people making the argument that banks themselves, especially at that size, either need to be regulated as utilities or they need to be broken into smaller pieces. Now, I'm relatively agnostic whether or not any of that happens. From a pure research perspective, I'm not sure that the cost argument, I mean, I know the costs of compliance are increasing. We see they're all adding to their compliance officers, but it's hard to say how much of that is in response to actual new regulation and how much of that is in response to scandal and it's partially marketing and PR. I personally am very skeptical of any move that any bank does as purely motivated out of sort of compliance or risk management. in terms of the cost argument, whether or not the increased regulation or overzealous regulators would actually add to the costs, I'm not sure that argument makes sense, especially when you offset it with impact to the banks. And when you're talking impact, the impacts are incredibly broad and systemic when something goes wrong.
Okay, but there's a certain narrative that runs through any policing effort, and that's the assumption that fund managers are out to make themselves money at the expense of the rest of us. Do you believe that fund managers are really the ones to blame, or has the regulatory world just been too slow to keep pace with change?
The answer is probably both. Fund managers, the banks, and even the regulators, they act on the incentives they have to act. So if a fund manager is paid to find the loophole and obfuscate and move quickly, then that's what they'll do at the expense of anything else. And if the regulators are largely either alums of major banks or they have ties to major banks, or even if they don't have ties to major banks, I mean, in the US in particular, most of the regulators immediately after leaving go on to consulting gigs with the major banks. There's some incentive to slow the pace of regulation, then that's what they'll do. So I think it's really a question of incentives. And in the EU, while they're trying to kind of cap the incentives, even trying to cap the incentives on bonuses, I'm not sure that that's really I think that almost misses the point too. I mean, it's how you're paying is the mechanism for pay is much more important than the actual implementation of pay and capping the pay.
Thank you for the insight. Matt Moscardi with MSCI.